Imagine the most iconic American chocolate company on earth, going on sale for 36% off. At the exact moment, its biggest cost just crashed 74%. Hershey, 203 million shares outstanding, 45% market share in U.S. chocolate, 16 straight years of dividend increases, and a stock that has fallen from $276 down to $176. But here's what nobody is pricing in. Cocoa futures, the single biggest input cost in Hershey's entire business, have already crashed 74% from their peak, and Hershey's earnings haven't caught up yet. All right, let's talk about the elephant in the room, the cocoa crisis, and why it's actually the biggest opportunity here, not the biggest risk. Between 2023 and the peak in 2025, cocoa futures rose over 70%. Climate disruptions in West Africa, which produces 70% of the world's cocoa, combined with old trees and disease, sent prices to historic highs. From its peak, cocoa has now crashed 74%. 74%. And Hershey's earnings haven't caught up to that yet, because the company hedges its cocoa exposure 12 to 18 months out. The cost relief is already in the chart. It just hasn't hit the P&L yet. Now, look at Q1 of 2026. Gross margin expanded back to 39.4%. The turn has already started. Wall Street is still pricing in the pain. The actual business has moved on. And on the valuation side, Hershey trades at a price-to-sales ratio of 2.99. Its 10-year average is 3.57. PepsiCo trades at 2.05, Mondelez at 2.06, Lindt at 4.63. Hershey is genuinely cheap, both versus its own history and versus its peer set. That gives a fair value of about $263 per share. That implies 50% upside from today's price of $176. The bull case is that you're buying a wide-moat dividend aristocrat with beta 0.08 at 26 times forward earnings, with cocoa costs already down 74% and the price recovery still ahead of us.